Welcome to U.S. Tax Classroom. Most people know that deductions reduce your taxes. It's kind of a given, right? But here's something not everyone realizes. There are actually two very different types of deductions on a U.S. tax return, and one type is significantly more powerful than the other. I'm talking about the above-the-line deduction. Understanding this specific mechanism completely changes how you see your entire tax return. It literally shifts it from a confusing chore into a strategic tool you can use to legally pay less tax. In this explainer, we're going to unpack what above-the-line deductions actually are and exactly why they hold so much more financial weight than your typical write-offs. We'll pinpoint exactly where they appear on the 2025 tax return, walk through some real-world math, and highlight which ones are most commonly missed so you can stop leaving your own money on the table.
Here's our roadmap for today. First, the tax return calculation. Second, the power of above the line. Third, Schedule 1 Part 2. Fourth, the new Schedule 1A. Fifth, a complete worked example. And finally, number 6, missed deductions and key takeaways.
Let's start with Section 1, the tax return calculation.
Okay, let's dive into this. The U.S. federal tax return doesn't just take everything you earn and immediately slap a tax rate on it. That's not how it works. Instead, there are deliberate layers of reductions along the way. Knowing exactly where those reductions happen is absolutely crucial. It's the foundational key to understanding how your taxes actually work. Let's walk through how this calculation flows in 3 very distinct steps. Step 1 is determining your gross income. This is absolutely everything you've earned from all sources during the year. We're talking about your wages, your freelance income, interest, dividends, rental income, and even retirement distributions. Basically, all of it combined into one massive bucket. Step 2 is where the magic starts. You subtract specific deductions directly from that gross income bucket. These are your above-the-line deductions. The result of that subtraction gives you your adjusted gross income. You'll hear this referred to heavily as your AGI, which sits directly on line 11 of Form 1040 for the 2025 tax year. Finally, Step 3 takes that AGI and you subtract either the standard deduction or your itemized deductions. The final result of that math is your taxable income. This is the actual final number on which your tax bracket percentage is calculated. Let's imagine a taxpayer named David to illustrate this flow clearly. From his wages, his gross income is $60,000. He claims an above-the-line deduction of $2,000. That subtraction means his AGI becomes $58,000. Moving down the form, his standard deduction is $15,750. Subtracting that final piece means his taxable income is $42,250. It really is a simple step-by-step subtraction. So gross income minus above-the-line deductions equals AGI. Then AGI minus standard or itemized deduction equals taxable income. That means above-the-line deductions happen at the very top, before anything else is applied.
Moving on to Section 2, the power of above the line.
To thoroughly understand why above-the-line deductions are so incredibly powerful, we have to compare them directly to below-the-line deductions. Those are your itemized deductions found on Schedule A. Below-the-line deductions, things like mortgage interest, state taxes, and charitable contributions, only produce a tax benefit when your combined total exceeds the standard deduction threshold. And here's the catch. In recent years, standard deduction amounts have increased significantly. For the vast majority of taxpayers today, just taking the standard deduction easily wins. That means you could rack up a massive $10,000 in legitimate, out-of-pocket itemized expenses and get absolutely zero additional tax benefit. Why? Because that $10,000 is still well below the standard deduction hurdle for your filing status. Above-the-line deductions function completely differently. They are vastly superior because they work for everyone with absolutely no threshold to exceed. There is no comparison test needed at all. Regardless of whether you itemize your taxes or just take the standard deduction at the end of your return, every single dollar of an above-the-line deduction reduces your AGI by exactly $1.
But there's a second reason they are uniquely powerful. And honestly, this is the mechanic most people completely overlook. AGI is not just an arbitrary milestone on your tax return. AGI acts as a gatekeeper. It determines your eligibility for dozens of other tax benefits, credits, and deductions. Many of the most valuable tax benefits in the entire tax code phase out or disappear entirely as your AGI increases. When your AGI gets too high, you might just lose access to the student loan interest deduction, the IRA deduction, the child tax credit, and the earned income tax credit. This means that proactively keeping your AGI low actively protects your access to these highly lucrative provisions. One single above-the-line deduction can create a massive domino effect of savings in multiple places at once. It saves you money directly through the deduction itself and indirectly by keeping your AGI strictly below a painful phase-out threshold.
Now, what's really interesting about this slide is how we can see this exact phase-out concept in action with a real example. Meet Sarah and Tyler. Both of them are single filers. During 2025, Sarah earned a gross income of $90,000. Tyler also earned a gross income of $90,000. Over the course of the year, Sarah paid student loan interest totaling $5,000. Tyler also paid student loan interest totaling $5,000. First, let's quickly establish the rules for this specific write-off. The student loan interest deduction has a hard maximum cap of $2,500. Furthermore, this benefit phases out for single filers when their income falls between $85,000 and $100,000. Let's look at Sarah's calculation first. Sarah made no other above-the-line contributions. Therefore, her income for this specific calculation remains at $90,000. That income falls right in the middle of the phase-out range. Because of that, her allowable deduction is reduced proportionally. Her allowed student loan interest deduction drops to just $1,667. We know her starting AGI is $90,000. The only subtraction we can make is that $1,667. That means her final AGI sits at $88,333. Now let's walk through Tyler's side of the board. Tyler paid that same $5,000 in student loan interest. However, Tyler also contributed to a traditional IRA in the amount of $7,000. His IRA contribution is an above-the-line deduction, so it is subtracted first. This brings his income for the student loan calculation down to $83,000. That new income figure is completely below the phase-out threshold. Because of this, he gets the full student loan deduction of $2,500. Adding his two write-offs together, his total deductions reach $9,500. His final AGI lands at $80,500. They had the exact same starting gross income and the exact same student loan payments, but the IRA contribution did not just reduce Tyler's AGI directly, it also unlocked a bigger student loan deduction that Sarah did not get.
Let's move to Section 3, Schedule 1, Part 2.
We've established the incredible power of these deductions. So where do we actually find them? Well, for 2025, above-the-line deductions appear on a secondary form called Schedule 1, Part 2. This section is formally titled Adjustments to Income. Let's look at the main deductions available to you here. First is educator expenses, which allows qualifying K-12 teachers to deduct out-of-pocket, unreimbursed classroom supplies. The limit for this is $300. For example, think of an eligible first-grade teacher named Maria. Her unreimbursed classroom expenses hit $300. Her direct above-the-line deduction is legally $300. Next up is student loan interest. As we just saw, interest paid on qualifying educational loans is deductible up to a cap of $2,500. Then we have traditional IRA contributions. Depending on your workplace retirement coverage, you can deduct up to $7,000. For those aged 50 and older, that limit increases to $8,000. Finally, health savings account or HSA contributions are incredibly potent. These allow deductions up to $4,300 for an individual plan. For family coverage, the limit jumps to $8,550. Now, please note that student loan interest, IRA contributions, and HSAs are so complex and so valuable that each has its own dedicated explainer coming up in this series to cover their full rules and hidden nuances.
Moving on to the rest of the Schedule 1 deductions, these offer immense value, particularly for self-employed individuals, freelancers, and small business owners. First, there is the self-employment tax deduction. This provision allows you to deduct 50% of the self-employment tax you pay on your net earnings. Then there's self-employed health insurance. Under this rule, you can deduct 100% of the medical, dental, and qualifying long-term care insurance premiums paid for yourself, your spouse, and your dependents. For retirement, SEP IRA contributions are a massive tool. This allows business owners to shelter huge amounts of profit from taxation, letting you contribute and deduct up to 25% of your net self-employment income. The absolute cap for this reaches an astonishing $70,000 for 2025. You will also find a line for alimony paid. However, this is grandfathered in and only applies to divorce or separation agreements formally finalized before January 1, 2019. Finally, there is the early withdrawal penalty deduction. If you were forced to pay a penalty to a bank for breaking a certificate of deposit early, you can actually recoup that penalty as a deduction right here.
Which brings us to Section 4, the new Schedule 1A.
For this 2025 tax year, we need to introduce a brand new form created by the recent One Big Beautiful Bill Act. This new piece of paperwork is called Schedule 1A. It covers 4 brand new deductions that aim to provide relief for specific types of income and expenses. These 4 are no tax on tips, no tax on overtime, no tax on car loan interest, and the enhanced senior deduction. Because these are entirely new to the tax code, each of these 4 has its own dedicated explainer coming up later in our curriculum.
We'll dive into exactly who qualifies, what the strict income limits are, and the exact mechanics of claiming them.
But here is what you absolutely must understand clearly about this new form right now. Despite having a nearly identical name, Schedule 1A deductions are fundamentally different from your traditional Schedule 1 deductions. The items on Schedule 1A are technically below-the-line deductions. They reduce your taxable income after AGI is already calculated, not before. This structural difference means they do absolutely nothing to affect your AGI, which means they cannot help you qualify for those other AGI-based phase-outs or credits we talked about. Imagine a restaurant bartender named Alex. Through his normal wages and tips, his calculated AGI is $40,000. From his documented tip logs, his no tax on tips deduction is $5,000. Applying this deduction does not lower his AGI at all. Instead, his deduction reduces his final taxable income down to $35,000. Schedule 1 makes AGI smaller. Schedule 1A makes taxable income smaller. Both matter, but they work at different points in the calculation. Now for Section 5, a complete worked example.
It is time to bring all these disparate concepts together. We really need to look at a single master example to show exactly how this math stacks up on a real tax return. Meet James. He's 28 years old. He files as a single taxpayer. During the week, he works a traditional full-time W-2 job. On the weekends, he drives for a ride-share company as a side hustle. This specific setup is perfect because it means he has both standard employment income and self-employment income, giving him unique access to multiple deduction types.
Let's move to and see how this builds step by step. His W-2 wages amount to $52,000. Adding to that, his net self-employment income from rideshare is $6,000. When combined, his total gross income is $58,000. Now let's calculate his deductions. First, the total self-employment tax on his rideshare income is $848. Because the IRS allows you to deduct exactly half of that, his allowable self-employment tax deduction is $424. Moving on, his traditional IRA contribution is $3,000. Because he is not covered by a retirement plan at his W-2 job, this entire amount is fully deductible. Finally, his student loan interest paid is $1,200. Adding those three items together, his total above-the-line deductions are $4,624. We take his starting gross income of $58,000 and subtract those deductions. This reveals an AGI of $53,376. For a single filer, his standard deduction is $15,750. Subtracting that final piece, his final taxable income is $37,626. Think about what just happened here. His tax is calculated on that much smaller $37,626 figure, not on his original gross earnings. That means over $20,000 of income is simply not taxed by using deductions that were already available to him. Finally, Section 6, missed deductions and takeaways.
Of course, knowing the math only helps if you actually claim the deductions on your return. Let's look at the most commonly missed deductions so you don't leave your own money behind. First, the self-employment tax deduction is widely missed because gig workers often do not realize they are officially considered small business owners by the IRS. Consider a freelance graphic designer named Chloe. After finishing her taxes, she finds her self-employment tax liability is $1,000. Thanks to this rule, her legal deduction is $500. She loses out on real tax savings if she simply doesn't know to claim it. Every single gig worker is entitled to this. Next is student loan interest. This is routinely missed because many people incorrectly assume tax deductions only help if you have a house and itemize your taxes on Schedule A. As we proved today, this deduction works completely independently of itemizing and can be stacked to unlock the full amount. Self-employed health insurance is also regularly overlooked, particularly by solo entrepreneurs paying expensive individual market rates out of pocket. 100% of these premiums are legally deductible above the line. Finally, the SEP IRA is heavily underutilized. Contributing to a SEP IRA can legally reduce a self-employed individual's AGI by tens of thousands of dollars in a single year, offering truly incredible wealth-building leverage.
So the crucial point is that above-the-line deductions reduce your adjusted gross income directly, way before the standard deduction is even considered. They are insanely powerful because they work for every qualifying taxpayer, with absolutely no standard deduction thresholds to exceed, meaning every single dollar counts. Most importantly, aggressively reducing your AGI preserves your eligibility for other credits, deductions, and phase-outs across your entire tax return. You can find all of these right there on Schedule 1, Part 2.
This explainer is really just the foundation. To ensure you maximize every strategy, here's the full structure for our comprehensive series. Video 1 is this explainer. Video 2 covers the traditional IRA deduction in full detail. Video 3 covers student loan interest. Videos 4 and 5 cover self-employment and home office deductions. Video 6 covers the HSA deduction.
and videos 7 through 9 cover the new Schedule 1A deductions, tips, overtime, car loan interest, and the senior deduction. The rules of the game are laid out right in front of you. The only question left is, will you passively let the tax code dictate your wealth, or will you use these powerful above-the-line strategies to legally keep the money you worked so hard to earn?